So that's why understanding and remembering your time frame is really key to investing, right up there with understanding your attitude towards risk.
Can you tell us a bit why time frame is really important for our clients to consider?
Yeah, thanks, Kath. Defining your time frame is absolutely key, not just to choosing the right strategy, but keeping in mind can really help to manage the more psychological challenges, should we say, of the ups and downs along the way when you're investing. So when you've got a longer term time frame, you've got a bit more capacity to take on risk because you've got the ability to hold on through any challenging times in the markets. Whereas if you've got shorter term money, it's got much less ability to actually regain any losses if you needed to take it out immediately. So when you're thinking about this, it's just important to remember that different kinds of asset classes have got different potential for growth over time. For example, shares have really outperformed bonds over the long term, but in the short term, they carry quite a bit of extra risk. So for example, on this chart that we've got up now, you can see the performance of the US share market as represented by the S&P 500 since about 1946. So those light grey shaded parts there are recessions. You can see that there's been plenty of peaks and troughs along the way. And if you zoomed in and took a snapshot of any one of those trough periods, it would look a lot more sharp and probably look a little bit scary. But despite that, when you zoom out over that longer term period, you can see that the long-term trend has actually been really positive. So that's why understanding and remembering your time frame is really key to investing, right up there with understanding your attitude towards risk.
Yeah, that's great. Thanks, Laura. So time frame's key.